This video will walk you through a debt investment that's considered available for sale. Just to recap, there are three types of categories into which a debt investment can be placed. It can be considered held to maturity, trading, or available for sale. And we've already gone through held to maturity. This will specifically focus on if the debt investment is considered available for sale. And just a reminder, available for sale means that our intent is to hold it into the future and sell it when the time is right. That's very loosely defined. So the problem that you've had available to you on the handout, I've just pulled out some of the key data here, and we're going to be walking through recording the acquisition, adjusting the journal entry at the end of the first year, receiving the first payment, marking to market, and then disposing of the debt investment. So hopefully you've gone through and tried this prior to viewing the video. I'm going to spend very little time on acquisition, which is the first step, because it's exactly the same as it was in the held to maturity problem that we've walked through, with one exception. The only thing that changes is the account that we classify the transaction to, and then we call it an available for sale security rather than held to maturity. But we still debit the long-term investment at its historical cost, which is 0.95027 times the face value of the bonds. The second part of the problem says let's adjust at year end for any accrued interest. And again, I'm not going to spend any time on this because it's exactly the same as the problem we worked through in held to maturity, and the amortization schedule is here. I changed this from held to maturity to available for sale because the amortized cost of the investment is what is going to go up, and it's available for sale, not held to maturity. And then on the following date, January 1st, 2012, we get the actual cash payment. So you can go through and review that. If you're having troubles with that, go back to the other video, and I'll walk you through it there. So that brings us up to number 4 here that says now mark to market. Now I will walk you through this because here's what's happened. We're to assume that the rates have risen throughout the year, meaning that our bond has decreased in market value. Now the problem was a little vague here, and what does it mean that it's declined by $5,000 and at what point in time? Well, remember we mark to market at the end of every year, and so I should have made this more clear in the handout, but we're going to mark to market at the end of the first year. So end of year 1, December 31st, 2011, we would have recorded the amortization of part of the bond, and our carrying value is now $96,529, and we're right here in year 1, end of year. And so what we're saying is, well, that's great, that's our amortized cost. However, the fair market value is $5,000 less than that. So what we have to do is mark to market. Since it's available for sale security, we have to create this thing called a securities fair value adjustment account. And since the value decreased, we have an unrealized loss. Oops. And we have a $5,000 unrealized loss. So this would be our debit, right? And this would be our credit. And unrealized loss, we should be more specific here. I'd go dash, not income, but dash equity, because in available for sale security, any gains or losses get flushed through to the stockholders' equity section of the balance sheet so that we're not playing with profit. And the credit goes to the securities, if I could spell it right, fair value adjustment account for the same amount, $5,000. And the securities fair value adjustment account is simply a valuation account, and it just keeps track of any changes in the market value of our investment. Notice that we didn't do anything to the available for sale account that we created right here during acquisition. That's because the change in value is stored in the securities fair value adjustment account. So that takes us through marking to market. Had the value gone up instead of down, I would have debited the securities fair value adjustment account and credited an unrealized gain dash equity. And the last part of this problem here is to say that we're going to dispose of the debt investment. So the problem tells you, and I just kind of summarized it up here, at the end of actually the beginning of 2012, which is right here, year 2, right? All of year 1 is 2011, and now we're January 1, 2012. We find someone to buy the bond for $100,000. So at the end of year 1, end of 2011, we would have have this available for sale security account in our records at its historical cost, plus we amortized 1502, which was shown to us at the accruing interest at the end of year one. Then we marked to market. Value went down, right? So now we're going to sell it. Here's how we're going to sell it. We're going to get $100,000 cash. It's only $10,000. $100,000 cash, and in exchange we're going to give up the available for sale security, and we're going to do that at the cost, so, or at the amortized cost. So the value of the available for sale investment completely gets wiped out here, and the difference between the two is an actual gain or an actual loss. And in this case it's a gain because I received, for some reason someone paid me more than what I said the fair value was worth, so I have an actual gain, and then this gain would actually go through the other expenses section of the income statement. So notice how that's different from mark to market, in that the market adjustment didn't go through the income statement of the available for sale, but now it does when I actually sell it. Notice I accrued no interest when I made this entry because I made the entry at the very beginning of 2001, and this is unlike the held to maturity problem, because I had no other time lapse and no need for any additional accrual of interest. Now, that's only half of this transaction, because now when I sell this bond, I'm assuming that's all I've got in my portfolio, I've got to do something with the securities fair value adjustment valuation account that's sitting over here. So logically, it's got to go away. So I would have, just be consistent here, so securities fair value adjustment goes away by whatever portion of the portfolio that was sold. This happens to be the only amount in the portfolio, so the entire amount goes away. Then the question is, what do I do with that? Well, you credit unrealized gain dash equity. Now this is confusing as to why we did, or it's hard to see the logic behind here, but logic tells you it all has to go away. Now why did it go to an unrealized gain or a loss dash equity? The logic here is that, you know, maybe during the year, remember it's only the beginning of 2012, maybe throughout the rest of the year we buy more available for sale debt investments, and then at the end of the year that value fluctuates. So this is just simply like this floating amount that gets reconciled at the end of the year to account for any changes in the fair value, and that's what's happened here. The actual gain or the actual loss gets pushed through when we actually sell it. So I didn't net the two and say that I have an $8,400 actual gain, because I don't. I only have a $3,400 actual gain, and this is unrealized. So that walks us through the end of this problem.